Now we want to look at ISM and what has been happening with the ISM numbers. So the ISM manufacturing dipped in January to 57.6 versus the estimates of 57.5. So again, right in line with where expectations were, but still down over a point from the month before. Now, new orders fell, which again is that leading indicator that points to additional slowdowns alongside production, backlog, supplier deliveries, and inventories. Prices paid, though, reversed higher to 76.1 versus 68.2. So again, you're getting that surge back up, which is some of that bigger concern that we have going forward when you're looking at what is happening on the inflation front and how much of that is going to be passed through. Now, as we said before, the employment, because when you saw that big dip in the employment side, we were saying that we expected that to bounce because that's really driven by the supply delivery issues. You had you had some assembly lines going off because they didn't have enough inventory, they didn't have enough raw materials. But then as that got better, then you should see employment bounce, and that was exactly what we had. But still, you were having that kind of negative move down, and we do expect the manufacturing front to come much lower, back towards just below let's call it 54, on its way closer to about 52. And here's some of the different issues. So the delays still remain high. That's not surprising, but we are getting some normalization. Now we do expect that to worsen a bit as activity increases. Obviously as we go into Q2. But the bigger problem is really prices paid. So prices paid is the one that is remaining the underlying problem, because that is that leading indicator for inflation. Where are prices going to be? Expectations for a lot of these surveys are showing that the people expect prices to continue to go up. But when does the consumer say, nope, no more? I can't. We've already seen the consumer go to alternatives. But once you've gone to that alternative, that now you're beholden, then you start really cutting volume. You really start to take that hit. And we haven't hit it yet. And that's, to be clear, we have not gotten to that point. But in my opinion, we are there now, and it's only going to get worse. When you look at the new orders, the slowdown, production should remain elevated, but the inventories is that stickiness I should say lumpiness with the GDP number, as we saw in Q4, and was our base case where we said, look, inventories are going to build. And the reason why we thought that was retail sales were going to slow, supply chains were going to catch up a bit, putting a lot in inventories, which is a net positive contributor to GDP, but very, very lumpy. And I think that's going to be a key piece going forward. So when we look at some of the recent data, and this is just what came out today, just so we have some of the different data points, but the unit labor costs, again, still remaining fairly low, expected at 1%, came in at 0.3%. Those costs are going to be the one to watch on how much that inflation continues to increase. And because of people quitting and the new hires, I think that increases March, April, May. It'll stay fairly sluggish in January, February, but we're going to see that really ramp up as we go at the end of Q1 and really take off in Q2. On the continuing claim side, again, jobs still point to tightening and a raise in rates. Service PMI pretty close to where expectations were. Expectations were 50.9, came in at 51.2. Again, fairly in line. Composite was expected 50.8, came in at 51.1. Remember, because we had that big drop in services, but as we were saying before, the drop was there, and then we're just going to kind of bounce to the sideways, and then we should get a gradual move up in service PMI as we go into March and April. While the manufacturing is the one where ISM service index it came right in line with expectations. Factory orders dipped a bit, but we already spoke about kind of why that's the case. But let's go a bit deeper into the numbers. So when we look at demand moderating, the manufacturing sector showed a further reduction of supply chain stresses, even as the Omicron variant spread rapidly in January. Something that we didn't think was going to be a big impact was COVID at this point. We thought it was going to be nominal at best. Production and employment held up while indicators of demand, notably orders and backlogs, receded. Again, demand is the one. That leading indicator on demand is why we remain very adamant that we are going to see a slowdown in activity Still positive, still growth, but again, still below what expectations are in the market. Though ripples from Omicron are likely to be felt in February, one takeaway is that sky-high goods inflation can moderate in 22 as demand and supply shift into better balance. And then when we look at the chart, the components grouped into categories indicative of demand and supply, with recent months showing a smaller gap in growth rates between the two. So demand outpacing supply by smaller margins, still elevated but coming down. Production and employment we think is just going to go sideways at this point, while inventories, imports start to come back up to above that level. But the demand, again, the white line and blue line are essentially going to converge on each other in positive territory, but again, there's still more slowdown. So when we look at prices paid, as we were saying, we expected to see that bounce. It's going to drift closer to 80, and then we think it really sits at this level and just goes sideways at this point. Survey was for 67, obviously came in at 76.1. And manufacturing PMI employment, again, right in line, bouncing in a growth level, staying in what we think is going to average out to about 53 if you think about the expansion side. ISM manufacturing supply side, when you look at manufacturing PMI supply deliveries, you see things are getting a bit better, but the backlog of orders is the place that we remain the most concerned, where you can see that it's moving further and further down, and we think that there's another drop coming, especially as we go into January and February, as the backlog of orders continues to dip, because people are still waiting for the products that they've already purchased. So why are you going to order something new? Let that supply chain catch up, which again is creating some of these issues. Kansas City Federal Reserve, the composite index, it came in at 24 versus the estimate of 21. New orders, production, employment, and 6-month outlook all up. Index was kind of bucking that trend. But again, this is why we look at regional. This was a positive one. As we've said, we've had some positive, we've had some negative ones. And that's why we think that, again, there's just going to be a slowdown. It's still I think Chicago was the only one that was negative, but the rest just showed either flattish to small beats or small misses, which again is just going to be that little drift to the downside as we look at what happens in Q1 of 22. Now, number of employees, exploded to the upside, but expected prices received also went up to the upside. They're both connected in this sense, where if you're going to be hiring new employees, they're going to be at higher prices, they're going to be at higher wages, so you're going to have to try to pass that through. So you see it completely taking out the highs. But again, prices received are just going to remain elevated across the U.S., and this is just one of a negative contribution, or at least a supporter of inflation. So the Dallas Fed manufacturing fell to 2 in January versus an estimate of 8. Production, shipments, delivery times, and CapEx all fell. New orders rose only marginally, and though employment dipped, it remains in expansionary territory. 6-month outlook picked up. So this again is just showing this was a sizable miss. You had a small beat, and this is again that supporting kind of our view of where this is going to go, and then leading to more support for tightening, even though things, everyone's concerned about what is the Fed what is the Fed going to do? Well, U.S. job openings and unemployed. When you look at the different aspect, less than one unemployed for each job opening. So there are more than enough jobs for anyone that wants to come back, keeping that competition high. Now, when we look at the headline growth for Q4, 21 GDP was strong at 6.9% annualized quarter over quarter. But inventories were a significant boost, and consumption was just slightly under expectations, but still expanded. So what do we have going forward? Inventories are going to continue to be a positive development, but consumer spending is the one that we're going to see the biggest issue. Consumer spending is the one that's going to really drag this down. And when you look at the percent of real GDP at essentially 70%, the consumer is a huge driver, a huge impact on where GDP is, which is why we think there's going to be that offset. While change in private inventories continues to be strong, and that's the fixed investment, still positive. But this is where the inventories is that lumpiness, which is why you can get a nice number and then a really disappointing one. And it's all going to be based on where do those inventories fall. But if I'm correct and the consumer spending slows, then that should keep inventories building, which will be a net a tailwind to offset the headwind. But just based on the percentages, the consumer spending coming down is going to have a bigger impact in the inventory build, which is, again, why we see that downward pressure. Now, December personal income came in at positive plus 3% versus the estimate of 0.5%. Spending came in at negative 0.6% versus the estimate, which was right in line. And again, just that personal income remaining under pressure. It's very consistent. We do expect personal income to start to ramp in March, April, May. But by how much, and can it catch up with inflation? And I think the short answer is no. Now, looking at some of the key pieces that the Fed focuses on, PCE inflation was higher in December, came in at 5.8% year over year, versus right in line with the estimate. Core PCE came in at 4.9% versus 4.8% estimate. Now, PCE inflation, fastest annual rate since 1982. Core PCE, fastest since 1983. December personal income, again, when you're starting to look at that, personal income was up 0.3%. But when you look at PC inflation, it's up almost 6% to give you an idea of where some of those pressure points reside. And when you look at just this move, you have to go all the way back to the late 80s just to get an idea of the last time we saw this kind of pressure, which is, again, why the Fed is going to be more aggressive in their actions. Personal consumption came in at 3.3% in 4Q versus the estimate of 3.4%, so just missed by 10 basis points. And that's something where when you look at the personal consumption overall, we think it's flatlining and then going to roll over as we've been discussing. But I think this is important, this chart, because it shows you just how much of a the increase in the change in private inventories drove GDP, because you can see the sizable move. But then go back through history. It's lumpy. You can see where it increases, but typically when you get a big increase, you typically have a bigger drop the next quarter. So this is, again, going to weigh because PC, services, goods, that's going to continue to be under pressure. Net exports, again, government spending is going to be under pressure, especially as there's conflict heading into the November election. So the change in private inventories was the driver, and that will drop off to a point in Q1 as consumers also slow. So GDP versus pre-pandemic trend. So when you look at not adjusted, inflation adjusted, to give you an idea, we're still not at where that trend line is, and some of that pressure continues in the system. Inventories accounted for the huge SARE, second biggest contribution since 1987, just to give you an idea and put it into scale what that means. Now, we think that will drop. If you look at in 1987, then there was an offsetting big fall. We don't think there's going to be a big fall. We do think that there's going to be another positive contribution. It's just not going to be to the same size. And as the consumer slows, that will be a bigger overhang. And then looking at the merchant wholesaler inventories from a different angle, expectation was for 1.2%, actual at 2.1%. So again, you're getting this pretty much across the supply chain from the consumer all the way up to the wholesaler, where we do have some inventories. But again, it's still near epic lows. It's just off the bottom and starting to see some of that come through. Now, the fiscal thrust is fading as government consumption's contribution to 4Q GDP growth came in at a negative 0.5%, lowest since the fourth quarter of 2013. And that's something, again, this is what, when we talk fiscal drag, this is literally the chart that shows that, where that fiscal drag, where people purchased what they could with the money that they got, and you'll see that have a sizable drop. Now, the goods contribution to 4Q GDP growth in blue bounced back into positive territory, with services still firm at 2.1%. We expect that to still be in positive territory, but again, just contract slightly as we see the consumer kind of peaking out. New record goods trade deficit reached in December. Yay, we did it, for better or worse. 101 billion versus the estimate 96 billion. Imports increased 2% to fresh highs, led by record value of consumer goods, capital equipment, and motor vehicle imports also up. Again, just because of these shortfalls, imports are going to continue to outpace. Now, looking at personal income and looking at the personal consumption side, personal income slightly positive, but personal consumption expenditures, nominal dollars, negative 0.6%. Then when you chain it and look at real, negative 1%. So again, there's that movement lower that we've been talking about, that we think it becomes that bigger pressure point. And it's showing up in some of the confidence numbers. So consumer confidence fairly stable, but it's well off its lows. Meanwhile, expectations for increases in income over the next 6 months haven't seen an impressive recovery and are well off of pre-pandemic peaks. And that's because there's a lot of concern of obviously keeping pace with that inflation. So even if income goes up, did it go up enough? And is it going to be able to allow me to maintain my normal, quality of life? Buying conditions of vehicles have fallen to all-time lows, and consumer sentiment index housing conditions have improved off the lows, but obviously still remain very suppressed and still rival the early 1980s. Job seeking and recruiting search activity suggested weaker jobs reports for January coming this Friday. We saw what happened with ADP coming in at negative 300,000. I think it's going to be a little bit of a pressure, but again, January, February are pretty weak times. And then we should see, obviously, that seasonal pickup in March, April, and then again, May. Now, when we look at some of the other positive sides, Chicago PMI stronger in Jan, came in at 65.2 versus 61.5. Prices paid, production, inventories, new orders all rose at smaller pace, but still expanding. So again, things are slowing, that pressure. But we also had backlog supplier deliveries at faster pace, both expanding, and employment fell at a slower pace and in contraction. So this mixed piece is where we continue to see some of these different structures. Fixed investment continuing to fall as a percentage of total fixed investment. ISM Manufacturing, again, just showing some of those leading indicators on why we do think that there's going to be more of that downward momentum in manufacturing. Consumer confidence, just labor differential. So this is looking at consumer confidence labor. And this is just more of a late cycle chart, just showing you where some of those pressure points are going to be and how typically there's a lot of pressure that comes after that, leading less in. This is kind of showing this is less more of a slowdown and showing that we're heading more into a recession. Still not ready to claim that. If there could be a recession, it would be official, quote unquote, in Q1 of 2023, and that's really if it kicks off in Q4 of 22, which is possible. But again, the leading indicators are going to be important to look at. Employment cost index was up 1% quarter over quarter versus the estimate of 1.2%. Prior figure, then when you look at some of the different increases, civilian workers, and then when you look at quarter over quarter, again, all very strong, showing where some of these costs are going to trend. And then when you look at University of Michigan, just kind of rounding out, consumer sentiment fell to 67.2 in Jan versus 70.6 in prior month, now at the lowest since 2011. Expectations fell to 64.1 versus 68.3, with the one-year inflation expectations unchanged at about 5%. So again, you can see that a lot of concern in the U.S. market from the consumer, from the employee, which is just kind of confirming what we think is going to happen on the consumer side, retail sales side, as we head through Q1 of this year. So now that we've wrapped up the U.S., we're going to go deeper into Europe. A lot of new information came out that we want to cover. So this one is going to have a bit meatier than some of the others that we've had over the last few weeks, and we'll provide some of that color in the next segment.